So, how many properties do you need in order to retire? This is a question that is on the internet, it's on all the forums, and everyone's got an opinion on it. So, today I'm going to unpack it and have a chat about what you need to think about to bring it all together. The reason that we invest in property isn't because we really like bricks and mortar, although for some people they seem to really enjoy buying and selling property. But the reason that we do it, it's a unit of investment. And the reason that we make this unit of investment is because we want to live off it in our retirement and do all the things that we never got a chance to do whilst we were working. So I have a few different ideas. I'll talk you through them in today's YouTube video. The first thing that we need to have a look at is how much money do we actually need in our retirement? A lot of investors really overestimate this. You gotta remember, by the time you're retired, we've got no kids at school, we've got no kids living at home, our family household living expenses relatively low, and also the things that we are going to be doing are going to be relatively inexpensive for the majority of our life. Hence the term kind of, little simple pleasures, and that's what retirement is made up out of. So for most couples, according to the Bureau of Statistics, they're looking for a household income of about $80,000 a year combined, and for a single, a minimum retirement income of about $50,000 a year. So we don't really need to have hundreds of thousands of dollars worth of income flowing in our retirement, because we just don't have that much to spend it on. When trying to work out what our portfolio is going to give us as far as return, there's three levers that we can pull or that we have access to. And our decisions affect these three levers, and then that gives us our outcome. So the levers are as follows. Number one, our total portfolio value. What have we managed to secure over our working life? Number two, the overall loan to value ratio of our portfolio. What have we managed to pay our debt down to by the time we retire? And the third one is our net yield after expenses. So all the properties that we've put into our portfolio, what is their rental income and what are the outgoing expenses? Because it's the net that is going to put the cash in our pocket for the next 20 or 30 years. Now, where many investors go wrong is they always focus on just the value of their portfolio and never think too much about the debt reduction or the net rent. And really, it's these last two things that are going to be the things that put the most amount of money in our pocket to fund our retirement. So how many properties do you actually need to retire? I've got three examples for you, and I've got these examples using actual Australian property data. So the first example is, what if we retired with just three properties worth an assumed value of about $700,000 each? For the scenario, we'll assume that we've bought these properties, we've let them grow over a 20-year period, and now we've got our $2.1 million worth of property that has about a 30-40% loan to value ratio. Furthermore, we'll assume that our net rent out of these properties after all expenses is about 3%. Now, this portfolio is going to deliver us, after all expenses and interest costs, income of about $50,000 a year passively, and then obviously you've got to factor in the capital growth of your $2 million worth of property should you sell it later on down the track. Now, $50,000 may not be enough for everyone to retire on, but if you're a single person, this is certainly an option. But what do those numbers look like if you've got 4 or 5 properties at, say, $650,000 each, and you've gone through the same cycle of letting them increase over a 20 to 30 year period? We get them down to a 30% loan to value ratio, and your net rent is the same 3%. Well, this will give you an income of about $80,000 to $90,000 a year. For many people, this is enough, and this is the sweet spot. You've got a reasonable sized portfolio. As you roll into retirement, you're certainly going to have good capital gain in the future, which makes you feel comfortable, but the day-to-day cash flow is probably what you're looking for at this point. And the last one is, what if you had 6 or 8 properties, same parameters, $650,000 each, 3% net yield, with a 30% loan to value ratio. Well, this kind of portfolio is where most investment property investors end up if they've been doing it for quite a long period of time. This portfolio should generate passive income in your retirement of about $110,000 to $130,000, which is enough to make most people pretty happy. At this level, retirees would have a certain amount of comfort, be able to do a certain amount of travel, and have the capacity to reinvest some of that income, and will be able to hold on to their properties for a little bit longer before they need to sell down in their retirement. They may even be able to hold on to some of these properties right through until the end of their life and give some legacy to the kids or grandkids. So, what are the 4 rules when it comes to setting up your portfolio for retirement? So, number 1, it's not just about the number of properties, although that is important, but it's more importantly about the debt reduction and the overall loan to value ratio. Having a smaller portfolio and getting it down to that 30% loan to value ratio is much better than trying to enter retirement with a lot of properties at a high loan to value ratio. Number 2 is you have to balance growth with cash flow. If you're going into retirement with a high growth portfolio where everything has a super low yield, but it's going to go up in value over the next 30 years, well, that may not be as suitable as having something that has a combination of high growth plus cash flow. Certainly, if you just have a cash flow positive property portfolio, it might be okay to roll into retirement with that. It certainly have the income that you're looking for, but long term, if it is legacy planning that you're looking for, you're going to want some of those high capital growth properties in there that are going to really give you the growth that will enable you to leave something for future generations. Number 3 is all about outgoings. Having, as we said before, a low yielding property that is subject to a lot of high costs, such as strata or tax planning, land tax, rates, all these kind of things, will eat away your returns and not give you what you're looking for in retirement. So it takes a little bit of knowing your math and numbers to be able to pick properties or choose to retain properties that aren't going to give you this kind of grief in the future. And obviously the last one is we want to have properties that we can retain into our retirement. So a lot of property investors think that as soon as they enter retirement that they will liquidate all of their properties immediately and have a big chunk of cash that they're going to live off. But that does them out of the possibility of future capital gains. So what we're looking for is we're looking for properties that we can keep long into our retirement. Certainly, if we can keep all of them, great. But if we can sell off 1 or 2 every 3 years or 5 years and dwindle them down, but still hold some property as we get close to our 80s, that's probably the best possible scenario. Now, you may have been listening to this going, well, that all sounds good, but I feel I'm missing something at the start. And the thing that most people miss at the start when they're looking for the end is what is the thing that fuels your early acquisition of these properties? You need to be able to buy them now and hold them for 20 years. What is the thing that helps you do that? And the answer is today's serviceability. So the key to getting any of this, the foundation, is understanding how much money you can borrow now and understanding which lenders are going to lend you the most amount of money, which lenders are going to enable you to purchase the most amount of properties, which lenders are going to be able to really help and support you in those early years whilst you're trying to acquire the assets that you're going to hold on to for 2 or 3 cycles before you get to retirement age. Serviceability is the key to setting up your portfolio. Once you've got your serviceability sorted, then you can go and acquire your properties in a very structured, thought out fashion. And then we hold those properties as we roll into retirement, reducing the debts as we go. So to summarize, how many properties do we really need? If we have 3 at a 30% loan to value ratio, we'll probably have an okay retirement. Certainly better than most. And when we put this in line with our superannuation, we'll have a pretty comfy retirement. If we can get to, say, 5 properties at time of retirement at a 30% loan to value ratio, you're certainly going to have a comfortable retirement and a retirement that most people are going to be quite happy with. The gold standard, however, is if you can get 6 to 8 and those properties are unencumbered by the time you roll into retirement, you're going to have a very, very sweet retirement. All the work that you've done to get to that point is going to definitely pay some serious dividends for you. So if you want to retire with these kind of portfolios, when do you need to start? You really need to start in your 30s and 40s. And you probably want to have the majority of your properties purchased by the time you hit 50, giving you enough time to get the cycle right, to get your loan to value ratio down in time for retirement. So if you are stuck there on 1 or 2 properties thinking, this all sounds great, but how do I get down that path to be able to achieve these goals? We do have another video that I'd encourage you to watch. I'll put the link below. Then by all means, reach out. Let's have a chat about your current portfolio, what you've been doing, and then we can have a look and see what we can do to get you from where you are to where you want to be. As always, thanks for watching. Remember to like and subscribe to our channel and share this with a fellow property investor that might be in the same situation as yourself.